We've experienced historic volatility amid the coronavirus pandemic and the government response. Was this a bear market that was caused by COVID 19? And is it still a bear market or is it a bull market?
In some ways, the answer to the question comes down to semantics and it comes down to normal. Let me explain. It's likely that the downward move this year in the market will go down in the history books as a bear market. The market fell 30+%. We had a pretty severe economic sharp contraction. And so likely it'll go down into the history books as a bear market. With that being said, to be a true bear market, you need two features. You need magnitude, the market falling, and you need duration. Your typical bear market lasts about 2 years. What we had this year was a downward move that lasted about 2 months. And because of that, the market is behaving more normal in a way that would be associated with a correction, a supersized correction. That's what we believe we just went through. With that being said, typically what happens in a correction, it's the category of stocks, the style that was performing the best before the downturn goes on to continue to perform the best, which is exactly what's happening right now. In a typical bear market, however, there's often leadership rotation, meaning that the things were leading before the downturn actually no longer lead, and off the bottom, most of the time, small cap and value stocks become the dominant style. That is not what's happening right now. So, importantly, whether you think we are in a brand new bull market or whether you think we're in the continuation of the previous bull market, it doesn't matter. What matters right now is that the market just rose from its March bottom 50%. We're in a new bull market, and a bullish feature to go along with that is that few people are talking about that.
What's the forecast for the remainder of the year and into 2021?
Somewhat ironically, our forecast for the period ahead isn't very different from what our forecast for the period ahead was when we started the year. Our original vision for the year, which we provided you, was for a year of good stock market returns, but not spectacular, back-end loaded, with interest rates wiggling only minorly, and being generally benign. And in the midst of all that, of course, we have had all of the things that everyone's had shoved in their face tied to COVID. But in fact, if you look at where we were on June 30th for the stock market as a whole, it's only about 3 percentage points worse on June 30th than the average election year in American elections. American elections, as we told you in the beginning of the year, tend to create a force of their own that is tied to the way markets work and isn't really tied to party A good, party B bad, or candidate A good, candidate B bad, and we come back to talk about that later. But it's tied to features of confirmation bias that propel the back half of the year to be the strongest part of the year. And then we would expect some variation in how 2021 would play, and we'll talk about that a little more later. But as you move to the end of the year should be relatively strong, not super strong, relatively strong, and lead to have that propel somewhat into 2021, where there's obviously more risk, but there's also more opportunities. Overall, the amazing part about this period is how not untypical the market has been for the beginning of an election year in America when there have been so many extraordinary things going on in that beginning of the year. Let me just add on a little bit to that. In a typical bear market, unlike what we saw in this year earlier, it starts off gently, slowly gets worse and worse, and then toward the end, in the last third of its duration, you typically get the plunging panic. And in that period, the market's doing a very particular job, sort of its, if you will, its day job. And that is, as we always tell you, the market tends to want to be pre-pricing and concerned about things in the next approximate 3 to 30 months. But in that sheer panic stage, as the economy is typically just falling apart into chaos, or seeming to at least, the market shifts to focus on the very short end of that 3 to 30 months, sometimes even popping out the short end of that. And it focuses very short term. Once it's completed focusing very short term for a little while and getting a handle to sort of its satisfaction, if you could think of it as a almost living, breathing, thinking thing, which it truly isn't, but it often acts like it is. Once it's done that, it kind of reverts to its night job, which is to be focused on the true long-term value of the future earnings of all corporations. And in fact, that's not very much impacted by the short term at all. So it shifts from being focused on the very short end of the 3 to 30 to the very long end of the 3 to 30. And this goes on every bull market. Every bear market bottom to bull market transition has that feature of it shifting from the short term to focusing on the long term. In this instance, with coronavirus, if you think out in the long end of that 3 to 30 months, you almost certainly either get A or B. A, you have a vaccine that works really well, or B, you have herd immunity, or I guess C, you have some combination of the two. And then when you think of the future earnings past that collectively for all corporations, forgetting about this one that got killed in the process and that one that did really well, when you value those, it immediately moves to see that the valuations aren't that different than before you started. So the market just steadily rises. That's the beginning of every new bull market.
And for views on current events in the world of investing, visit marketminder.com. Updated daily, it offers on-demand access to Fisher Investments' most current thoughts on capital markets and the global economy, as well as our sometimes irreverent commentary. We hope you will enjoy it.